Amid the third wave of the COVID-19 pandemic, the government has marginally lowered its estimate for the country's GDP growth rate for 2021-22. Given this, markets expect the finance minister to deliver yet another expansionary budget to keep the economic engines going. Finance Minister Nirmala Sitharaman is scheduled to unveil India's union budget for FY 22-23 on 1st of February. And market mavens expect the focus to be on job creation and income support and capital spending besides rural and healthcare expenditure. That said, analysts also expect fiscal consolidation to start in this budget as revenue receipts, especially customs and direct taxes, are better than anticipated. Moreover, relatively contained spending so far could give the government the elbow room to maintain large fiscal accommodation. However, the feasibility of the same will depend on government's ability to cement higher growth in direct taxes and garner disinvestment receipts. We spoke to Deepak Jasani, Head of Retail Research, HDFC Securities, to understand this better.
Budget provisions will need to give the right signals to the Indian people and investors from abroad. In FY23, we could see the winding down of pandemic stimulus plus normalization of economy provided COVID does not keep recurring, and also the divestment of BPCL and LIC. Hence, a fiscal target of anything around or just under 6% is doable. In case this comes in at close to 5.5%, then the street may get excited. However, nominal GDP growth may come in slower at close to 13% versus 18% in FY22. Also, if the government is required to do additional spending by way of extension of free food grain scheme for a period of 6 months and higher spending on Manrega, then the path to fiscal consolidation would be even tougher. We need to remember that in case interest rates continue to keep rising, the gross borrowings by centre and states in FY23 of rupees 22 to 24 trillion could create an additional pressure on the rates. However, focus on fiscal consolidation, continued RBI intervention in the bond market, possibility of inclusion in global bond index and some moderation in inflation in H2 FY23 is likely to provide support to yields. Budget is likely to propose to exempt Euroclear settlements from tax, possibly the final step for India's sovereign bonds to be included in global indexes.
Jasani also expects the government's focus on PLI schemes, asset monetization, infra spending and support schemes for rural India and smaller businesses to continue. Increase in healthcare infra, reducing tax compliance burden, special treatment to trade, travel and tourism sectors could also be in the offing. For Amnish Agarwal of Prabhudas Leeladhar, populist measures ahead of 5 state elections may include focus on the middle and the lower class of the country. He expects higher allocation to the Manrega, PM Kisan scheme and farm loan waivers to please the rural people and higher standard deduction for personal tax for the middle class. Echoing similar views, Nishchal Maheshwari, CEO of Institutional Equities at Centrum Broking, expects the markets to eye roadmap of PSB privatization and taxation parity of mutual funds.
I think tax collections have been pretty buoyant in the last year, and despite the COVID, and I continue to believe that as we go ahead, basically, they will continue to be in a good state. In this kind of a situation, I believe one could look at some rationalization as far as GST is concerned, and that would ease the pressure on inflation also, so as to give some respite to the general public. Another interesting point from the capital markets point of view could be how the 5-6 PSUs, especially on the banking side, if the government can give out a plan how they will be privatized, and again, if the taxation on the front of debt as well as debt mutual fund, if parity is bought in that.
While all these announcements are being factored in by the markets, there are some areas that analysts want the government to focus on. These include clarity on cryptocurrencies and their taxability, exemption to be given on transfer of shares in the scheme of amalgamation, which is held as stock in trade. Reconsider dividend distribution tax rules introduced during Budget 2021. Tax incentives for investment in infrastructure investment trusts. Nonetheless, D Street investors have begun readjusting their portfolio ahead of the D-Day, with benchmark indices already up around 2% till January 19. Since 2010, the markets have risen 7 out of 14 times on budget day. This time around too, markets may cheer budget 2022 if it delivers on expected lines and/or gives better than expected economic forecast. However, any negative surprises on fiscal front may halt the rally on the bourses.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.